Where in the heck did this month go? We're in the last trading week of June, and do you believe half the year's already over so far? Well, today we're going to talk about what economic news is hitting the markets this week, and there's only really one thing, and it is a huge thing. It's the number one inflation figure that the Federal Reserve watches and monitors. So today we're going to go over what the economic calendar looks like for the week, and then I have Federal Chairman, a guy that sits on the Federal Chair of Chicago. He's coming on to do a brief little interview on CNBC. We're going to go over that because he's talking today, and every time somebody from the Fed talks, the markets move. So let's get over to today's agenda. Here's where you're seeing with mortgage rates right now. These are the top 6 programs people use when they're buying their first house. Now, let me explain to you guys what these rates are. They're not my rates. These aren't any individual bank's rates. What they are is Mortgage News Daily, right there at the top. They survey lenders all over the country, and they asked them these 5 questions. They said, if you had a borrower that was looking to buy their first house, so first-time home buyer, they're buying a single-family home and it was going to be their primary house. However, these people also have to have this as the criteria. When you look at it right through here, it's a 75% loan to value, meaning they're putting down 25%, and they have a 780 credit score. So if that's you, well, most likely this is going to be what your interest rate's going to look like. But if that's not you, I'll give you all my information at the end of this video because I'm actually a loan officer licensed in all 50 states, and why aren't you working with me? So let's get over to today's calendar. So that when you go through Yahoo Finance, and I usually go to CNBC or Yahoo Finance to kind of pull up the news for the day, and here's what's showing up right now. Fed's favorite inflation gauge takes the spotlight this week, and we're going to talk about that here briefly. And then how long will interest rates last? Bond market says maybe forever. So let's get over to it. Here's the economic calendar for the week. Monday, nothing. Tuesday, consumer confidence. That's kind of teetering on, good and bad. It depends on how that data comes in, but it's good one time, bad one time, and so forth. But the reading that we're looking for is all the way to Friday morning. The PCE. That's the one inflation level or indicator that the Federal Reserve truly monitors. They give this the most relevancy. So let's get over through here. Fed's favorite inflation reading is what's highlighting this week, and that's basically right through there. So let's get over here. Right through here, Steve Leasman from CNBC, he's interviewing the Chicago Fed Goolsbee. Now, Goolsbee is more of I'll say a dove. He likes to give us the data that's, well, let's say, put it this way. He always gives us pretty good data. But then I think he gets in trouble with the Fed behind the scenes because when he comes out and talks, usually the markets do pretty good. And then that's what the Fed doesn't want to do. So let's listen to Goolsbee here, and then you tell me what he's expecting from interest rates. Because you go through a lot of these things, and it's like, how long are you going to keep interest rates high? Here, let's look at this there. There's a caption coming up. Where is it? And I wanted to show you guys. But it basically was saying, how long do we have to, right through here, how long do we have to keep interest rates high? Be surprised. It might be a long time. So let's see what he has to say about this, and then we'll come back and discuss it. So without further ado, take it away. This is Steve Leasman, and he's talking to Goolsbee, who sits on the Federal Reserve. Take it away, Steve.
Good morning, Austin.
Hey, Steve. How are you?
Great. Listen, I want to just start off with the getting a tally here. Where are we on the countdown to cuts? Are we, is it 3-2? What's the score here?
Who's on which team? I'm not allowed to talk for anyone else on the FOMC, so I know you're not asking.
Did you hear that? So, yeah, I think he gets in trouble a lot. I'll kind of interject here when I think it's needed.
Me that. I've been saying
your assessment.
My assessment is that I've been laying out for more than a year what are the criteria that we would see for rate increases, for rate holding, for rate cuts. I think we've got somewhat historic restrictiveness. The Fed funds rate minus inflation. The real Fed funds rate is as high as it's been in decades. When you want to be that restrictive is when you feel like there's danger of overheating, or as we did in the U.S., if you get the inflation rate up too high. Second half.
Okay, so what I want you to understand is what he said through here, and I hate to do this to rewind it. You guys need to understand the data that he's talking about. So let's go back. Hopefully I rewound it long enough. I want you to understand when he says the rates are restrictive enough. I want you guys to understand that, and I'll break it down to show you or explain to you what he's talking about.
Cuts. I think we've got somewhat historic restrictiveness. The Fed funds rate minus inflation.
Okay, the Fed funds rate right now is 5.3, about 3.3. It ranges. It's 5.25 to 5.5. So that's where the Fed funds rate is. Inflation, where he's saying, okay, you take the Fed funds rate minus inflation, it should be zero. Okay, that would be neutral. If the rate is higher, that means they're restrictive. So the federal funds rate right now is 5.25 to 5.5. Inflation, let's say it's 3.3. So you can see there, let's say the current funds rate is 5.3. Inflation is 3.3. So that means we're still at a positive 2% when it comes to rates. So that's what he means by we're still restrictive in a restrictive territory. I want you guys to understand that because that's what the Federal Reserve is working on. Are they restrictive enough on the federal funds rate? Is it high enough to cure inflation? And that's basically the concept what he's talking about right here.
The real Fed funds rate is as high as it's been in decades. When you want to be that restrictive is when you feel like there's danger of overheating, or as we did in the U.S., if you get the inflation rate up too high. Second half of last year, we had outstanding dual mandate performance. That is, inflation came down almost as much as we've seen in any year, and we did not have a recession. Start of this year, we saw inflation kicking back up, and we've been trying to figure out and determine from the data, is that a sign of re-overheating, or is that just a blip? I think if we get more months like what we have just seen in the last month on inflation, coupled with slowing conditions in some of the other parts of the real economy, then you would have to start questioning, should we remain as restrictive as we've been?
Right. And I get that. The question I know, I'm just wondering where you stand in terms of having that confidence to cut. And when I said 3 to 2, I meant 3 bad months. And we've had, I don't know if you describe it this way, but 2 good months of inflation, especially the last one that we had. And I'm looking at the Cleveland Fed now casting for inflation. It looks pretty good for the month of June so far. Obviously, it's just a forecast. But where are you in your confidence to cut it?
Yeah, look, I'm the closet optimistic that we're going to see improvement. If you break down the housing, services, goods, you started to see the progress that we have been expecting on housing beginning. Hopefully that continues. And on services and on goods, there's still a decent run rate. So even the 3 bad months, we really had 1 awful month in January. And then it's been improving since then. And that was preceded by 7 outstanding months. So I'm hopeful that we're going to get a little bit more confidence that on the inflation side we're heading back to 2, and on the real side, you can't describe this as traditional overheating at the least. You've got a couple of warning signs. If you look at rising UI claims, if you look at rising delinquencies, and what seems to be a cooling of consumer spending, I just think, taken in the context of how all the other advanced economies are doing, it's worth wondering about where we are on our restrictiveness scale.
Well, yeah, I wanted to get to that because there's a chart up right now, Austin, that.
Does it seem like he's really timid to answer the question? Like he wants to say all indicators. He said 7 out of 8 months. There was 1 bad month in there. He said if you take that out, but then he starts catching himself saying, well, but this is where the Federal Reserve wanted us to be. Here's where the inflation rate was. Right through here, this blue line, it was way up through here. It's come way down. And then remember the Federal Reserve came in, they said, we need the unemployment rate at 4%. Well, they got it now. So that's where that's at. So let's continue with the interview. Pretty cool.
It shows the inflation rate, which is the blue line, declining, and the unemployment rate actually inching up. I know it's still at a very low level. You talked last week, Austin, about pain in the economy. How much concern do you have about a slowdown? And tell us where we are on the golden path. Are we back on the golden path? Are we potentially veering off it to the other side, which was the side of greater economic weakness?
Yeah, that's always the danger. I'm always going to be concerned. You know, I say central bankers' job, be concerned about everything. That said, you got a couple of warning signals coming from the real side of the economy. The golden path was my description for 2023, that we could get inflation down a lot without having a recession. Now, let's hope we still get a little more of the golden magic coming here into 2024. And I, as I say, I'm closet optimist. I think it is possible. But you cannot help but look at the real side economy and conclude, I think, this is not overheating. Okay, the reason to be extra restrictive, as we have been, is because you're trying to guard against overheating. If unemployment claims are going up, the unemployment rate is inching up. Many of the other measures have cooled down to something like what they were before the pandemic, and you start to see weakness on consumer spending. I think then you got to have what we call the balance in the mandate, that we got two sides of the dual mandate. And if you're going to be extra restrictive for too long, you're going to have to start worrying about what's happening to the real economy.
When you talk about confidence to cut rates, Austin, do you agree with Chair Powell, who has talked about cuts being a process? Or is it possible to do what Christine Lagarde did in Europe, which is to do one and then kind of not promise additional ones? And just by way of background, the Fed did that back in '96, which is something that Vice Chair Jefferson has brought forward as a potential analog for today. To do a cut, hang out, see how it works, rather than essentially tell the market and the country that you're doing a process or series of cuts.
This sounds like an abstract.
Okay, so he's going to ask this question. He's going to dance around it because obviously they don't want to come out and say, yeah, we'll cut once or whatever. But here's where the federal funds rate, here's the possibility of the cuts. You could see way over there in July, not much of a possibility that they're going to cut rates, 10%. Then when you start seeing September, November, December, those are the remaining months. Let's see what he says about the potentials. But I still don't, honestly, guys, I didn't review this video before we did it. So I'm watching it with you guys, but I kind of know what he's going to say, and I'm interjecting as we go through. So sorry about that. I'm just revealing the truth behind the scenes on this one.
Abstract hypothetical, and I hate abstract hypotheticals. I usually always agree with Chair Powell.
I disagree,
so
Austin. Austin, I disagree. It's not theoretical. Chair Powell said specifically that he sees cuts as a process. He said very much that on the one hand, why do one cut if you're not going to do a series of cuts? So that's why it's not a theoretical thing. It's something the chair actually said.
I got you. I'm not going to weigh in on that's going to break the FOMC communications policy on two grounds. I'm going to start talking about thoughts that are in Jay Powell's head and the future about what the rate cuts are going to be. I don't like tying our hands, even partially. I do like the idea that as we make movements, we're not willy-nilly surprising people. What I like is for the public to understand our reaction function. And I like that over the last year and a half, we've laid down criteria for here's what we're looking for in the economy, that we're going to actually look in the data, and that's what's going to determine whether we're able to make cuts, whether we're going to hold where we are, whether we're going to increase rates. All along that way, I feel like we've been pretty clear about that reaction function, and that I take as a good sign that the market's reactions often are biggest when the data come out, not when we make statements. To me, that's kind of an indicator that we're doing the communication.
Okay, though that's enough of that. So I hope you understand. Let me know down below, do you think he's more dovish? Meaning he's saying that rates are coming down and we're going to cut. Or do you think he's going to be more hawkish, meaning he's thinking that, we're not there yet. There might even potentially be a rate increase down there. So let me know if you're hawkish or dovish down below. So that's the content that we have so far right now. So let me just put this into context. Here's where the federal funds rate is. This is the rate that the Federal Reserve controls, okay? It's not a rate that you and I pay. Basically, it's interbank lending. So let's say, for example, Bank of America at the end of the day, let's say they have to have $100 million in reserves to be able to close for the day, okay? But they don't have it. Well, they have to go to another bank and get that money lent to them overnight, and that's what this is. Okay, so then when they're saying, one of the captions in the headlines when you get to the news is right through here, how long will interest rates stay higher? Maybe forever. Well, let's get over to where the rates have been. So let me get my head out of the way real quick. Well, maybe higher. So here's what we've had over the last, let's say, 10 years. All right, it was basically down through here, almost zero, 0.14. Okay, so obviously it's going to be higher than that. Then it went up to the 2% range and so forth. So, that's where they're hoping to get it. But what is it right now? It's 5.33. This is what we were talking about earlier. So, is it going to stay higher for longer? Well, if you see through here over the last 10 years, half of those years were basically almost zero. Well, yeah, it's going to stay higher for longer. So you got to really watch a lot of the talking points that come out. So now let's get over to the CME FedWatch tool. Now, this is basically a tool that the CME put together, and it gives us the projections or the percentages of what in the world is the Federal Reserve going to do at the next meeting or next few meetings. So you go down through here and this says, what's the likelihood the Federal Reserve will change the federal funds target rate, not mortgage rates, not car rates, not credit card rates, the federal funds rate. If you go down through here, there's still a 90% chance that they're not going to do anything at the next meeting. Okay, so I know you can't see behind my, but let's look at the probability of what they're going to do down the road. Okay, so I'll get my head out of the way one last time. You go through right through here, and look, there's a 61% probability now that they're going to cut rates at the September meeting. If not, in the November meeting, if not, then in the December meeting. So one of these meetings they're going to cut. Okay, most likely. So that's what we're expecting right through here. But for this week, if you're sitting on the sidelines waiting for rates to plummet before you buy, it ain't going to happen, folks. So we'll probably be in these ranges, probably 6.5%, 7% range, the latter part of this year. And then when the Fed cuts start to come, the normal rate. Remember when they said, are we restricted or not? Well, we need the federal funds rate to get back to like the 2% or 3% range. And then when you have a normalized market, where a normalized market would be in today's world, we'd have rates about 5.5%. So, but I'm not expecting them to hit 5.5% this year. I don't even know if they're going to hit there next year. So my goal is to be in the 6% range from here, basically through the end of 2025. And then from there, I don't know. And we'll keep monitoring the data as we progress through. So like I was saying at the beginning, way back there at the beginning of this video, if you're out there and you need some help when it comes to buying your first house, maybe buying your first investment property, or maybe your second home. You might be looking to refinance right now. There's a lot of people. I was driving around my neighborhood over the weekend, and there is tons of construction going on existing homes. People are putting on additions and fixing their homes. We'd love to help you with all those. If that's you out there and you're looking just for some kind of mortgage for either to buy or refinance or something, rehab your house, we'd love to help you. So visit us at therateupdate.com. Here's our site. The first thing I want to ask you guys to do is if you're out there looking to buy your first house, check out the Grant Finder. That is the #1 tool that you got to use to see if you're eligible for any grants to give you some help when it comes to down payment or closing costs. But the other piece is right through here. The Apply Now button, that's where you need to go. Or if you're like, hey, Dan, can I just call you guys and get the ball rolling? Yeah. Scroll down to the bottom of our website, and there it is, 844-775-5626, or you can email me directly at dan@therateupdate.com. So thanks so much for watching, guys. God bless. Have a fantastic morning. I'll see you at the closing bell. Take care. Bye-bye.